You can wreck a $5,000 account by ignoring position sizing, how much money you put into any single trade. One win makes you feel smart, then two losses size too big, dig a hole. You can't think clearly from down there. The setup wasn't the problem, not the chart, not bad luck. Risking 20% instead of 2% was. Next you'll see why random losing streaks are normal, and why that single rule keeps small accounts alive. A solid setup can lose 3, 4, even 5 times in a row. That sounds wrong at first. But it's normal, and missing that truth is how small accounts get wrecked. Grab a coffee mug and 20 poker chips, or coins, or scraps of paper. Mark 12 green, mark 8 red. Green means the kind of trade that works often enough to be worth taking. Red means loss. Now shake the mug. Pull 5 without looking. You can easily get red, red, green, red, red. That ugly streak does not mean the bag is broken. It does not mean your method suddenly stopped working. The losses just happen to bunch together. Traders have a name for those unavoidable clumps. They call it variance. The normal swings you can't avoid, even with perfect play. What's interesting, your account feels streaks before your brain understands them. At 9:42 a.m., after 2 red trades in a row, your phone feels heavier. The notebook on your desk fills with angry little X marks. Your next decision gets shaky. Now map that bag to your account. If each red chip costs 2% of your account, 5 reds hurts. But you're still standing. If each red chip costs 10% or 20%, the exact same random streak does way more than hurt. It changes how you think. You stop following your plan. You start trying to win it back fast. That's the whole reframe. A losing streak is not proof you're broken. It's a weather event. Your account has to survive. If this clicks, subscribe. You'll get 2 practical reframes like this each week. So the real job is not predicting which chip comes next. The real job is making sure the next 5 red chips, if they show up, cannot knock you out. Which raises the question, before you even enter, how do you lock in the exact dollar loss you're willing to take? It's 9:31 a.m. Your chart looks perfect. Your finger hovers near the mouse, but the first number you write isn't your dream profit, it's your max pain. Grab a sticky note. If your account is $5,000, 2% is $100. So this trade can hurt you by no more than $100. Not $300 because you feel sure. Not $500 because the setup looks clean. 100. Fixed. Now you work backward. You pick the price where the trade is proven wrong. Traders call that a stop loss, a preset price where you automatically exit a losing trade. Say your entry is $50 and your stop loss is $48. That means you're risking $2 per share. Now the math gets simple. Your max loss is $100. Your risk per share is $2. So your size is 50 shares. Traders call this position sizing, how much money you put into a single trade. Notice the order. Loss first, size second, entry button last. Most beginners do the reverse. They start with, how much can I make? Or worse, how much do I believe in this? Traders call that conviction, how strongly you trust your trade reasoning. The market does not care. The 2% rule protects you from your own excitement. It stops one bad trade from becoming a bad week, and it does something even better. It keeps your brain calm enough to follow the next plan. The pattern is clear. 2 people can take the exact same setup, be equally wrong, and one barely feels it, while the other needs a week to recover. I took the same trade as you. That sentence hides a huge difference. You and your friend both spot the same move, same chart, same entry, same stop, the price where you exit to cap your loss. By 10:14 a.m., both trades fail. You are equally wrong, but your friend loses $80, shrugs, and logs the result. You lose $800, stare at the screen, and spend lunch replaying every click. The setup wasn't the part that changed, the damage did. Say your account is $5,000. If you risk 2% on one trade, your max loss is $100. That's the 2% rule in plain English. One trade takes a small bite, not a giant chunk. Now compare that with someone risking 10%. Same $5,000 account, same bad trade. But now the loss is $500. Nothing magical happened in the market. The only difference was position sizing. This is why 2 traders can share the same win rate and get totally different results. One can survive a rough week, the other gets knocked off balance fast. Run the math for a losing streak. 5 losses in a row at 2% risk doesn't feel good, but it takes your $5,000 account down to about $4,520. Painful, yes. Fatal, no. 5 losses in a row at 10% risk takes that same account to about $2,950. Now you're not just annoyed, you're in a drawdown so deep that your next decisions start feeling personal. And that changes your behavior. You hesitate on the next good setup, or worse, you size up because you want the money back now. That's emotional trading, making trades driven by fear, excitement, or ego, not a plan. Not because you're weak, because big losses make your brain loud. Small risk does the opposite. It buys you emotional room. You can lose, record it, and still think clearly 15 minutes later. That's the whole point of the rule. Not to avoid losses. You can't. The point is to make losses boring. Here's why it works. Once losses get boring, something powerful happens. You stop asking, how much can I make on this, and start asking a better question. How much of my account should this idea be allowed to touch? And that's where most beginners get the order completely backwards. It's the same edge a poker player has at the table. The discipline to fold a tempting hand when the numbers turn, and the nerve not to tilt after one bad beat. It's 10:12 p.m. Your trade journal is open. There's a coffee ring on the page. 5 red X's stare back at you in a row. Nothing feels more personal than that streak. You start thinking the market hates you, or that you've suddenly become terrible. But 5 losses in a row can happen even when your idea was fine. Take a small account. Say it starts at $5,000. You spot the same kind of setup each time, same chart pattern, same plan. The only thing that changes is how much of your account you let each trade touch. First version. You risk 10% each time. That means each loss costs about $500 at the start. Loss 1 hits. You drop to $4,500. You tell yourself, no big deal. Next trade. Loss 2 hits. Now you're near $4,050. Loss 3. Around $3,645. Loss 4. About $3,280. Loss 5. Roughly $2,950. Same trader, same setup, same 5 losses. But now your account is down about 41%. Traders call that a drawdown. Here's the part beginners miss. To climb back from a 41% drawdown, you don't need 41% to recover. You need almost 70%. That's a mountain. Now run the exact same week again, same account, same 5 losses, but this time, each trade is capped at 2%. So the first loss is about $100, not $500. Loss 1, about $4,900. Loss 2, around $4,802. Loss 3, near $4,706. Loss 4, about $4,612. Loss 5, roughly $4,520. You still hate the streak. Nobody enjoys 5 red marks, but now the damage is about 9.6%, not 41%. Annoying, yes. Fatal, no. That's the whole power of position sizing. It doesn't make you right more often. It changes how much random pain you can survive before your brain starts doing stupid things. Because after the 10% version, your thoughts change. You start moving your stop loss. You start taking trades that weren't in your plan. You start trying to win it back fast. That's revenge trading. Taking a bigger, sloppier trade right after a loss. After the 2% version, you're still irritated, but you can still think. You can still sleep. You can come back tomorrow and take the next clean setup without feeling like rent money is on the line. And that's why the 2% rule matters more during boring losses than exciting wins. Wins make you feel smart. Losing streaks reveal whether your rules actually protect you. Poker has the same lesson. A player can lose 5 hands in a row with great cards played well. The pro survives because the bets were sized to survive the streak. The amateur goes broke, proving the cards were good. So when people say, I only lost 5 trades, the real question isn't how many, it's how much damage each one was allowed to do. And once you see that, the next question gets a lot more interesting. Why does small risk help you make better decisions, not just smaller losses? Here's the weird part. Small risk doesn't just protect your account, it protects your brain. When too much money is on the line, every tick feels personal. A tiny move against you feels like an insult. That's when calm thinking disappears. You start negotiating with the screen. So here's one rule you can actually use, the position sizing first rule. Quick aside, if this helps, subscribe for more twice a week. It has 3 steps. First, pick your stop loss before you even care about the entry. Second, cap the loss at 2% of your account. If your account is $5,000, your max loss is $100. Third, set your position sizing from that number, not from your confidence. So if your stop is $2 away and your max loss is $100, you can only take 50 shares. Not 80 because the setup looks clean. Not 120 because you really like it. 50. That does 2 things. It limits damage, and it keeps your thinking clear enough to follow the plan. You don't freeze. You don't widen the stop. You don't start revenge trading, taking a bigger, sloppier trade right after a loss. And once that rule is in place, one simple weekly habit makes it far easier to actually obey. Next Monday, before the market opens, write one number on a sticky note. Your max loss per trade. If your account is $2,500, that number is $50. Then every trade has to fit inside it. If it doesn't, you pass. That single habit protects your capital, your trading or investing money. It protects your head too. Want more plain English breakdowns like this? Subscribe. The next one shows what to do after 3 losses.